This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home. That's why I go beyond the transaction to share my tips, insights, and opinions for adulting made simple. I am so excited today to have not only one of my very good friends, my Impact Sisters, but also my CPA, Jan Pacenta, in the studio today. This is amazing. I've been trying to get her on this podcast for so long. Thank you so much, Jan, for being here.
Thank you so much for the warm introduction, Jessica.
So, a little bit about Jan, and I'm going to let her tell a little bit about herself as well. But not only is she my CPA, I think she's one of the best in town. And just so you know, before I ever hired her, I interviewed multiple CPAs, about 8, I think. And she was the one with all the right answers. So, she's the one, of course, I chose for my businesses. You are a shareholder here locally and a partner at what's the name of your firm?
My firm is named Brown Thornton Pacenta.
Where are you located at?
I'm in downtown Pensacola,
And you've been doing this for a long time now. About how many years?
about 30 years, specializing in businesses and individuals in multiple industries.
Awesome. And you are always my go to. Before I make any major move, any major purchase, I call you. How is this going to affect me? What do I need to do? Not only is she brilliant and grounded, she is really involved in this community. She gives back to this community as you sat on the Impact 100 board and were a treasurer, what, four
4 years.
years? Yes. So I love that about you. And I love how down to earth and real you are. So thank you so much for being on the show.
Thank you.
So today we are going to be talking about the big beautiful bill. There's been so much talk about it, so I'm so happy to clarify what it is, how you can use it. We're going to talk about individuals, families, businesses, all the way to real estate investors. Go through it all. So no matter who you are, if you don't know what the big beautiful bill is, this is your show. If you know what it is but don't know how it affects you, this is definitely your show. We're going to dig in deep on the big beautiful bill today. Sound fun?
That sounds great.
Awesome. And before we kick off too much about the big, beautiful bill, I do want you to tell a little bit about yourself. Just tell us a little bit about you and a little bit of your personal life.
I'm born and raised in Pensacola, Florida. I have a husband and 2 children. My daughter just recently moved back, which made me very happy. I've been involved in numerous community events from Junior League, Cultural Center, Council on Aging, Impact 100, as well as with my church.
Awesome. You're just a good person overall. So, what exactly is the big, beautiful bill? Can you explain that for someone who has no idea what the big, beautiful bill is? Please give us a brief synopsis because I know it's really big.
Yeah. The Big Beautiful Bill is an expansion of the 2017 Tax Act. This bill provides broader deductions and credits and incentives for both businesses and families. The most significant part of this bill is it increases take home pay for many Americans. For example, many families can have a tax reduction of $1,000 to $2,000 in their annual tax bill.
So, this bill has gotten so much attention. Why, from a CPA perspective, why has this gotten so much more attention than all the other bills that have been passed? Why is this such a big topic of conversation?
One thing people did not know is the 2017 tax bill, those incentives and credits were sunsetting in 2005. So this brought more incentives and credits for future. It also reshapes pass-through deductions and depreciation rules and phase outs that touch every member of the community.
Okay, so we're going to dig into that a little deeper, but let's say this sort of in plain English terms, right? So that's
Yeah.
for those of us who are used to paying quarterly taxes, we sort of understand what you just said.
Right.
And the American who doesn't pay quarterly taxes, they may not understand that.
Right.
So basically, there was some tax incentives that were going away.
Right.
That's what you mean by
Right,
sunsetting, right?
Yes.
So they weren't going to be there anymore. So they were expiring and
They were
taxes were going to
expiring.
go up.
An example of that is the standard deduction, which is now for married couples over $30,000. That was supposed to retroactively go back to the 2017 level, which was 15,000.
So it doubled. I mean, that's huge for
Yes,
an
yes,
average family.
Yes.
Yeah. Okay. So there was some stuff that was going to expire. And then you talked a little bit about pass through.
Yes.
So we're going to dig into that when we talk
Okay.
about business owners a little bit more. What's the most practical day to day impact that this bill has on someone's life? And I'm not talking about business owners or investors, just day to day human who doesn't own a business, doesn't pay taxes quarterly, isn't buying real estate. How does this bill affect them?
This bill increases their take-home pay. People will see higher take-home pay due to increased standard deductions and family credits, an extra $200 to $300 per month helping to ease the cost of groceries, utilities, or even allowing for occasional family outing.
And the reason for that is because it went from 15 to 30, right? 15,000 to 30,000 as a standard deduction?
Let's talk. Okay, let's go back.
Okay.
Okay, stop. The $30,000 was made part in 2017.
Mhm.
It was supposed to expire in 2025 and go back to 15.
Mhm.
So it's just that's not a new standard deduction. It's just an expansion of the standard deduction for more years.
And is there something going on in this bill that's on top of that that's gonna make people bring 2 to $300
Yes,
more a month?
expanded tax credits as well
Oh,
as
wow.
bonus depreciation, etc.
So not only did it expand the tax credits that were there to make sure we continue to at least bring home
Right,
what we were bringing home,
right.
there's more additional credits
Yeah,
to help us bring
yeah,
home more
yeah.
money. And is that for only business owners? Is
No,
that
it's for
only for the high
individuals.
income?
It's for individuals. It increases the amount of student loan interest people can deduct, which is great for singles and couples starting out in their trying to pay off their student loans over a period.
So what do you think is the most standout benefit when we're talking about families, employers, and freelancers? What do you think the biggest benefit to this bill is?
Families will see the expanded child care and dependent care deductions increase.
That's great. So that means that childcare that they pay for, they're going to get to write that off on their taxes and get more of their income back.
Yes. And that is actually a credit, not a deduction. A credit actually saves you dollar for dollar for your taxes.
Perfect. Yes. We like that, right? Is there anything that has to do with medical expenses on this bill?
Yes, this eases the medical deductions starting at 7.5% of your adjusted gross income. It expands your child care to an additional $3,000 per child, and it keeps student loan forgiveness tax free.
All right. So childcare is a higher deduction. Your medical expenses are a higher deduction, and student loans are a higher deduction.
Right.
So that's not business owners. That's just the average family that they can take these deductions.
Yes.
Great stuff there. So let's dig into small business owners because that is also what helps run this
Right.
economy and helps keep America going are all these small businesses. So what did that do for them? Did this bill introduce just for small business owners?
One of the most beneficial things for small business owners is a provision called Section 179. And that provision was supposed to reduce the amounts, etc. This bill permanently sets the Section 179 deduction to 2.5 million and restores 100% bonus depreciation for equipment purposes. That means for a small business is if you purchase a piece of equipment for $200,000, you get a write-off in year one for that, which that increases cash flow for the businesses so they can purchase additional supplies, spend money on personnel to expand their business further.
So if a business needed to buy some equipment, they now bought a $200,000 piece of equipment. They can now write that all off in the first year instead of paying that amount towards taxes, which then allows them more money to put back in their
Right.
business, whether they want to expand it, hire more employees. It also helps create spending, which
Check.
helps us all at another small business,
Right.
right? So that definitely will help our small business owners. Now, as far as an LLC, an S corp or sole proprietor, and those that don't own businesses, those are the different types of business structure that are most common. So when we look at those three types, is there anything different for them?
No, the same limits and the increased Section 179 and bonus depreciation applies to everybody. One of the other tax credits that these businesses had over the last 5 years was they get a deduction called the QBI deduction, which is a deduction that based on your equipment purchases, sales, etc. This 20% deduction was set to expire in 2025. This bill made it permanent.
Awesome. So it made those permanent, and you get that bonus where you can
Right.
take it all off in that first year. So definitely helping our businesses out there. So what's something that most small business owners are going to forget about or overlook and not think that this is something I need to tell my CPA about?
One of the new credits out there that is very well almost overlooked is called the research and development credit. And it expanded this. For example, in your business, if you have a custom software program written, you can actually deduct that up front instead of carrying the cost over 5 to 10 years.
Oh, wow. So I can do some research and development, maybe create my own software to manage something or a process to manage
Right.
something, and I would be able to deduct that cost in the
Hmm.
first year
Yes.
instead of spreading it out like I used to be able to.
Correct.
Okay, so we've talked about the individual, We've talked about the small businesses. Now let's talk about my favorite thing, the impact on real estate.
Right.
Since you know I am a real estate agent, this is what I love, and I'm a big proponent. We go to work to make a living, which means we pay our bills, but we buy real estate to build wealth, and they're two total different things. And I'm not just talking about investors, but even a homeowner. You buy a home versus renting a home to build wealth. That's what gets us further down the line to be able to, trade that equity in on the next house and eventually have that house that's paid for, right? So, when it comes to real estate, how could this bill directly affect housing affordability in the real estate market so we can get more of those people to start building wealth?
This bill is great because it boosts the depreciation deductions up to 80% bonus depreciation, and it also includes special rules and incentives for if you do real estate transactions in an opportunity zone. So an opportunity zone is some where you're disadvantaged and you're trying to build first-time home buyers and etc. And you can get extra benefits by doing that while at the same time you're providing housing for the members of the community that need it so bad.
So, for if you were a builder or developer in the area, which I know a lot of people get frustrated with our builders and developers in this area.
Yes.
Every time I list a big parcel, they're like, don't sell it to a builder. Like, I get to choose who buys it.
Yeah.
But
Really.
they get frustrated that the builders and the developers are, taking the land. But this actually incentivizes them to build more affordable housing.
Exactly. And that's part of that was enterprise zones are trying to build more affordable housing, and they're targeting tax credits for the builders and developers so that we have more affordable homes
Yeah. So reward those builders for building affordable homes.
and revitalizing the area around them.
What are some of do you know some of the areas in Pensacola? I know there are some in the downtown
Yeah,
area.
yeah,
I don't know all the layouts, but I have been a part of a couple of different projects at
right,
downtown that the people who bought the houses had to qualify within a certain income bracket. They couldn't make over a certain
right,
amount.
correct.
And sometimes there's deed restrictions on those that even going forward, the people that buy those homes must have an income under a certain amount to keep that as affordable housing.
Right.
Is there anything a homeowner should consider from this bill?
Homeowners get the increased it used to be there was a limit of 750 or 500,000 on a mortgage for deduct the mortgage interest.
Mhm.
That is increased to 750,000, which is
Oh, good.
more for the people that have the higher homes. Another thing is the salt deduction, which it doesn't affect this. It affects this area, but not as much as other. Basically, the salt deduction is real estate taxes, sales taxes, property taxes, and state income tax. The limit used to be $10,000. So if we're lucky, our property taxes are lower. But if you have three or four properties that are just investment or whatever, you can now deduct up to $20,000 for property taxes.
And even people who don't necessarily live in Florida, because in Florida,
Right.
we don't have income
Right.
tax. And we have pretty low property taxes,
Right.
although people here don't think they are, compared to many states where like a quarter of
Right.
them.
Right.
If we have listeners all over the country. So here, that's not as
That's
huge of a
huge.
deal. More northern states that have huge tax bills and huge income tax
Right.
bills, that's really going to benefit them. And
Yeah.
it's just
I have
driving more
several
people to Florida.
I have several clients in the Northeast, and they're between property taxes, sales taxes, and state income tax. They can be 20 to 30 or $40,000.
Wow.
So
That's a lot. And they're now able to deduct that as well.
$20,000 of it.
So now we've talked about homeowners, we've talked about the businesses a little, we've talked about individuals. Let's talk about investors and landlords,
Okay.
which I get even more excited. So, how does this affect investors and landlords?
This bill, on top of the increased depreciation boost in Section 179, you can appreciate there's a 20% repair depreciation allowed. And you also, as I stated earlier, the QBI, qualified business. If you've got an investor that is active in their real estate business, they can deduct up to 20% of their net income. Now, there's limits. It's based on sales, net income, payroll, and the value of the property.
Does that also include bonus depreciation or?
Yes, bonus appreciation on certain things. For example, your building land is not depreciated ever,
Mhm.
and that's a common mistake that a lot of people make. They just take the full cost, which that will under IRS audit, the IRS will dock you for that. And but when you buy a building, what happens is it's a building. So the bonus depreciation you can get a cost segregation study, and that will break out the building into fixtures, etc. Those fixtures, etc., we could be a 7-year depreciation. The new flooring could be 10 years, etc. And so, bonus depreciation, you can write up the cost of those assets, not the total cost of the building.
And that's a huge, huge point that a lot of people miss. And if this is something that interests you, don't worry. We're going to do an entire episode on bonus depreciation because we can dig so deep in this. But that is something that a lot of people miss. When they see 100% depreciation, they think, okay, I buy a $700,000 condo that I'm going to Airbnb. I can write that 700,000 off. That's not necessarily the truth,
No,
right?
no.
So you have to have a cost segregation study and you have to break down.
Right.
There's the cost of
Yeah.
the portion of the land you use on a condo where you don't own 100% of the land, you own a portion. And then also, it's the cabinets and the
Etc.
screws and the everything in the house. How long is that going to last? Expected to last, and you're able to write a percentage of that
Cost
off.
segregations are here for good. And the nice thing about it is if you buy the $700,000 condo, the usually cost segregations break down about 20 to 30%
Mhm.
are the components that you can write off for bonus or quicker depreciation.
So that $700,000 condo, that first year, somewhere around 30% possibly, you would be
Correct.
able to write off the first
Correct.
year. And that's where we'll dig into that bonus depreciation on the next episode because that's a huge tax advantage for many high-paying W-2 employees.
Correct.
All right, so let's clear up some confusion, right? There's always a lot of gossip, a lot of talk. What is the biggest confusion about the big beautiful
The
bill?
biggest confusion is it's for the ultra wealthy, and that's not correct. As we discussed, the child tax credits, the child care credits, as long as increased salted property taxes, etc. This benefits everybody, families, middle income people, and wealthy individuals.
So don't get me wrong, it does give people with multiple homes some tax
Right.
credits. It does give investors and builders some tax credits.
Mhm.
So they're not getting the shaft on this at all, but there is a lot more to all income
Right.
levels.
And when Congress and the president did this bill, they wanted to provide broad-based tax relief for all incomes levels, and this bill did it.
So I know you're on social media, do a little Facebook,
Right.
Instagram. I don't know how involved you are on TikTok, but what are you seeing that they're totally getting it wrong? I'm sure you saw the little post all about it.
TikTok says this is free income. And another we're going to get into later, but when you buy a property, there's a difference whether you're a real estate investor or not. To be a real estate investor, you have to actually work more than 750 hours in your property or 50% of your full-time job. TikTok is not telling you that. So there's actually income limitations. If you're passive, if the real estate is considered passive income, you can only write up $25,000 of that property in the current year, and that is subject to a phase out over 150 if you make over 150,000. TikTok eliminates this. They also provides targeted support and it requires careful estate planning rather than offering a universal approach.
So is there any one rumor you want to clear up about it?
I debunked the unlimited SALT deductions. We talked about earlier the state and local thing. It is not unlimited. It is $20,000. So TikTok makes it seem if you buy properties all over and you have, $60,000 of property tax and state income tax, you can deduct it all. That is not correct.
All right, so let's talk about those high income earners because we do have clients of those as well. And we're proud of them and the businesses they've started and what they've achieved. So, how does this bill affect those multiple income households?
What it does phase outs for people with multiple incomes. And it safeguards the QBI and itemized deductions under $1 million. And it's a smoother paying for a two-career family.
Okay, in English, please. For those of us who don't know all of those terms, can you just
Some
break
of
that
those
down a little bit
phase
easier?
outs for example, your Roth conversions, your itemized mortgage interest limitations, charitable contribution limits. It has higher phase outs for those.
So, if you're itemizing, you're going to be able to take more of the deductions
Right.
than you could in the past.
Yes, yes. And if your house is more than 750,000, if your house is 750,000 or less, you can deduct more of the mortgage interest.
Perfect. So, besides bonus
Mhm.
depreciation, using real estate as an investment strategy, which we'll talk more on the next episode about, but what about those high income earners specifically? So, over $1 million, we know we can do bonus depreciation with them and really use
Yeah.
real estate there as a strategy. Okay, so let's just pause for a second and explain the difference between a Roth and a traditional IRA because they're very different. But traditional IRA, I'm going to be taxed when I receive the income out of the IRA. On a Roth, I'm going to receive the income tax free, correct?
Correct. And what makes it nice for a Roth conversion, let's say you have a traditional IRA at age 40 that is worth $100,000. A good tax planning thing is to convert that into Roth. You do pay the taxes on the value of that Roth at 37%. But what happens with that $100,000 IRA once you convert it to Roth, it can grow to 500,000, 700,000, whatever for the years for how many years you own it. Then when you take it out, it's tax free. So it eliminates income taxes to the seniors when they are enjoying their retirement.
And you mentioned a backdoor. So, with the Roth IRA, one of the disadvantages for multifamily income is, if you make over a certain amount of money, you can no longer contribute to an IRA, but there's a backdoor way to do that.
Yes,
Can
there's
you
a
explain that?
backdoor way. You do a Roth IRA, and the income limitations for Roth IRAs and traditional have increased.
Oh,
That was
good.
part of this tax bill. And so you do a non-deductible IRA, which has higher income limitations that you can do. And then you convert that non-deductible IRA into a Roth IRA the next year. You pay the taxes on the value of that conversion now, but once you retire at age 65 to 70, you can take that money in your Roth IRA out and there's no taxes on this. So it saves taxes for seniors and it's a great planning purposes.
Yeah. So I can put money in a traditional IRA this year, wait a year, then take that money and roll it over to an Roth IRA.
Right.
And now, when I receive the income in my retirement years, I'm not being taxed on it, correct?
Correct.
That is a great planning for retirement and definitely a great tactic to use. So let's talk about the long term financial lens. What do you see happening 5 to 10 years from now? What is going to be the impact of this big, beautiful bill?
Partly the estate plan, the estate limit is now 15,000. Looking 5 to 10 years out, this bill will spark growth and income. So more business will be investing in these long-term assets, the capital assets, and getting current year tax deductions.
So, more businesses are going to spend more money, which
Correct.
creates more jobs and
Yes.
gets more taxes.
And those with deductions and Roth moves that helps you compound your wealth.
So, I can put more money into my retirement and not have to pay taxes on it in the future. I'm
Correct.
just converting everything into basic terms.
Correct.
Jan is so smart and her knowledge is so deep here that sometimes she forgets that we don't know as much as she
Yeah.
does, right? So, what is something that in this bill that people won't feel immediately, but they are going to feel the effects of it?
The long-term growth, the long-term economy, because businesses are providing more opportunities, more real estate, new businesses are gonna open up, so you'll have new business opening up, whereas more housing, affordable housing in areas.
And that's all stuff that takes time. You're not going to feel it tomorrow,
Right.
but it takes time. So, how should people adjust their long term financial goals based on this bill?
What you should start do is you start prioritizing. We talked about there's called a thing called Roth ladder. So you want to do if your IRA is 600,000, you want to do a certain amount each year to convert it because you don't want to pay all the taxes in the first year. Doing that and optimizing your business entities with the expanded opportunity for business depreciation.
And I got a simple one, just call Jan.
Correct. Correct.
Just call Jan and she will absolutely help you figure out what you need to do like she does me. And I'm telling you, I really don't even make a major purchase without calling
Yeah,
her. She
call
can
your
attest to that.
CPA before you do anything. I can't tell you how many times people have come in at the end of the year and said, "This is what I've done," and it's something that if we had done planning, we could have saved them additional taxes.
So you actually appreciate that I call you and text you?
I appreciate I want the emails, calls, letting me know what's going on in my client's life.
So let's have a little fun with this big, beautiful bill. So, from pour me a margarita to pop the champagne,
Yeah.
how excited are CPAs about this bill?
CPAs are very excited because this is a growth center. This is for growth for the markets, growth for businesses, growth for real estate investors, and a simplified approach. For years, we've had this income limit here, income limit there, and it's been confusing. This is a simpler bill.
Perfect. So, I hear, and I don't know if it's a rumor and I don't know if it's true. So, I need you to clarify, is there a yacht clause in here? Is there something to do with yachts?
There's not a formal, but you can take Section 179 as long as the business, the yacht, etc., has more than 50% commercial use.
So, if I use it to show people property on the water,
Yes.
maybe one day I'll get that yacht. Maybe one day.
But one of the things in this, as we talked about with the real estate professionals and the yacht clause, you need to document and you need to have a log. If you're going to have a yacht clause, you need to have a log that this is personal and this is business because that will come up on your audit. And if you get audited, you need to make sure you've got stuff to back it
Absolutely.
up.
Don't lie about it. Are there any other quirks or surprising cool little things that you want to share that you found that you were like, wow, that's sort of funny?
There's an interesting one. Cryptocurrency mining is you can get energy credits for that. It's legitimizing what started as a risky business into legitimate tax efficient ventures.
Thank you so much, Jan, for breaking down the big, beautiful bill. And we're going to do another episode where we're going to dig deep in just a minute. So they'll air at a later date. So if you loved hearing Jan, then definitely stay tuned to the next one. Tell us a little bit, though, about how people can reach you and who your ideal client is.
My ideal client is individuals and businesses. Small businesses is my niche. We deal with small businesses and real estate investors, physicians, etc.
Well, we'll put her info in the show notes. So if you want to reach out to her, please feel free to. We would love for you to connect with her. Obviously, I value her immensely and send her everyone I talk to. Thank you so much for joining us today. Remember, it's just my opinion. If you like what you heard today and you want to know more, make sure you like, subscribe, follow wherever you are listening to us so you never miss an episode. If you have a question, don't hesitate. DM me, text me, call me, email me. I would love to get your question answered on the show, and I may just invite you to be on the show. Also, if you have an idea for a show you want us to talk about, send it to me. I love your ideas and I love to answer your questions. Thanks for joining today. And remember, this is Jessica Duncan, and it's just my opinion for adulting made simple.